He bought his first stock at just 11 years old. By the time most teenagers were learning to drive, he was already making more money than his teachers. Today, Warren Buffett is worth over $100 billion. He's called the Oracle of Omaha and considered the greatest investor of all time. But here's the question no one's asking. How did he do it? What's his secret? While the world panics during market crashes, Buffett remains calm, buying when others are selling. Because Warren Buffett doesn't gamble. He follows a hidden formula, one that anyone can understand, one that you can copy. In this video, we'll reveal that formula step by step, using real examples, practical advice, and Buffett's exact strategy to build wealth the smart way. Get ready to see the stock market like Warren Buffett does. Section 1. Buffett's simple philosophy. Buffett's approach combines two powerful investing schools, value investing and business quality. Most people chase stock prices. Warren Buffett chases business value. He looks at companies like Coca-Cola or Apple, not because their prices are rising, but because their businesses are unstoppable. He calls this buying a wonderful business at a fair price. Buffett says, "It's far better to buy a wonderful company at a fair price than a fair company at a wonderful price." He spends 80% of his day reading, studying balance sheets, understanding companies inside out. He doesn't care about short-term hype. He only cares about what the business is truly worth and whether it's on sale. Section 2. Buffett's hidden formula unlocked. So, what exactly is Buffett's secret formula? He looks for three things before investing a single dollar. 1. A great business, something with a long-term advantage. 2. Great management, honest, smart leaders with integrity. 3. A fair or cheap price. Only buy when it's below its real value. Buffett calls these economic moats, like castles protected by a deep trench. These moats make it hard for competitors to take their customers. Apple has a brand moat. Even if a competitor makes a better phone, people stay loyal. Buffett also uses a tool most people ignore: intrinsic value. It's like calculating how much cash a business will generate in the future and translating that into today's dollars. If the stock is trading for less than this value, he buys. If it's overpriced, he waits, sometimes for years. Buffett says, the stock market is designed to transfer money from the impatient to the patient, and Buffett is the most patient investor alive. Section 3. Real-life examples. Let's look at 3 real examples of Buffett applying this formula. First, Apple. In 2016, Buffett shocked the world by buying a tech stock, Apple. He didn't buy it for the technology. He bought it for its ecosystem, loyal customer base, and massive cash flow. Apple had pricing power, global reach, and unmatched customer loyalty. That's a moat. Second, Coca-Cola. Buffett bought Coca-Cola in 1988 after a market crash. He saw a simple truth: people would always drink Coke. In good times, in recessions, across countries. It was cheap at the time, undervalued. He bought and never sold. Third, American Express. In 1964, the company was hit by scandal. Stock dropped. People panicked. Buffett saw past the noise. He knew the brand was strong. Customers still trusted it. He invested heavily. The value recovered and multiplied. Section 4. How you can copy Buffett's strategy. Now comes the best part. You don't need billions to follow Buffett's strategy. You just need discipline. Buffett says, risk comes from not knowing what you're doing. So start by investing in businesses you understand, products you use, brands you trust. Read the company's annual reports. Check their profit history. Look for growth, consistency, and low debt. Then wait. Don't rush. Let the price come to you. Buffett waited 50 years to buy Apple, then made billions. Once you buy, hold for the long term. Ignore market noise. Let compound interest do the magic. Buffett says, our favorite holding period is forever. Patience is your biggest advantage. While others panic, you grow. Section 5. Buffett's rule: never lose money. Warren Buffett's most famous advice is simple but often misunderstood. He says, rule number 1, never lose money. Rule number 2, never forget rule number 1. But what does that really mean? After all, no investment is risk-free. What Buffett means is, don't gamble. Don't invest emotionally. Don't follow hype or make decisions based on FOMO. He protects his money by sticking to what he understands: businesses with predictable earnings, strong brands, and low debt. He avoids hot tech startups with no profits. He avoids industries he doesn't fully understand. Buffett once said, "If you don't know jewelry, know the jeweler." In other words, if you're not sure, don't bet. That's how you avoid big losses. Even if you win less often, what matters is that when you win big, and when you lose small. Buffett also keeps a lot of cash ready during market booms. While others are buying overpriced stocks, he's waiting. Then, when the market crashes, Buffett goes shopping, buying great businesses at discounts. That's what never lose money really means. Protect your capital, wait for the right pitch, and swing only when it's a guaranteed hit. Warren Buffett's formula is not based on luck, but on logic. He doesn't buy stocks, he buys businesses. He doesn't panic at market noise, he does his research. And most importantly, he always protects his capital. Rule number 1, never lose money. You can start simple too. Pick 5 companies you know and like, understand them, check their financials, and invest at the right price. Be patient because compound interest grows slowly but surely. If you enjoyed this video, please like, subscribe, and tell us in the comments, what is your favorite long-term stock? Until then, think like Buffett and invest like Buffett.